Hello and welcome everyone. My name's Paul Foreman, International Sales and Technical Manager at Novia Global, and delighted you could join us once again for the latest in our Pulse Advisor webinar series. Today we're joined by Abika Martin from LGT Wealth Management, one of our partners on the DFM side of things. And the topic is how to position and navigate those crucial ESG conversations with your clients. Now, ESG, or Environmental, Social and Corporate Governance, to give it its full title, is certainly something that we're seeing increasingly in media articles, and particularly post-pandemic has gained a lot of traction with clients, and I'm sure is forming more and more part of your conversations with your clients as you engage regularly with them. So hopefully over the next 40 minutes or so with Abika's session, we'll be able to bust some myths or confirm some of your assumptions. At the end of the session, there will be time for us to take questions, but as usual, there is a tab at the bottom of the screen. If you want to fire off any questions during the presentation, I will collate them and we'll go through them together with Abika at the end. So with no further ado from me, I'll hand you over to Abika now. Thank you.
Thanks, Paul. I think if we start sort of setting the scene, I'll pick up on that point about this increased demand that investors are seeing, because when I started my career, what we then called ethical investing was really something of a footnote. And occasionally you had a client who was vehemently against a specific company or a sector and wanted it excluded. And that was it, really. That was the extent of our ethical investment toolkit. In fact, the only exclusion I had to navigate in the first 4 years as an investment manager was a client who had been sat on the phone to BT for too long and didn't want it in his investment portfolio anymore, out of revenge because he'd been on hold. But the world has changed, not necessarily hold times, I'll give you that, but sustainable or responsible investing is no longer niche. It's increasingly mainstream. In fact, according to Investment Association, in 2020, UK investors put on average £1 billion a month into ESG investment, which was up an incredible 66% on the previous year. And even more telling is that it isn't just what those investee companies are doing that is sort of mattering to clients, but it's actually the conduct of even the fund houses that are buying those stocks that is mattering to people. So just this month, when Sustainable Investing, or the company that present as Sustainable Investing Specialists, Federated Hermes, they were found to be sponsoring a group in the States that was lobbying against climate action. They actually said that if companies divested from fossil fuels, they would no longer put their money with these companies that were divesting from fossil fuels. So really lobbying against the investment community working towards or against climate change. And Federated Hermes were found to be sponsoring them. But criticism was from stakeholders and media was so great, even after they put out this sort of holding statement, absolving them of responsibility, that they've actually been forced over the course of a few weeks to terminate that sponsorship and to no longer partner with this company, this organization. So a huge amount of pressure on the funds themselves, the fund managers, not just the companies that they are buying. And in August last year, when questions were raised around the sustainability claims of DWS, the Frankfurt-based sort of ETF provider, the share price dropped 15% in reaction. Now, that share price drop is a great illustration, a great example to use when you consider what actually moves markets. Partly it's the inherent value of a company, and partly it is sentiment. So if the share price comes off 15%, it tells us about sentiment and value, right? It tells us, firstly, there is a clear financial value to being able to authentically meet the demand for sustainable investment. So there's a value in that, possibly 15%. And secondly, it tells us that organizations being inauthentic in meeting that demand, greenwashing, will be punished. There is zero tolerance for companies that are playing at being ESG, but not really delivering. And unsurprisingly, that means there is an increasing amount of regulation around this. It's increasingly on the agenda. And the FCA sent a Dear CEO letter just last year, July last year, basically calling out that there's this kind of flood to the market of products claiming to be ESG, but perhaps they're not as ESG as they say. So this Dear CEO letter was stressing that ESG strategies must be very clearly described, what makes them ESG, and substantiated. So don't just say, oh yeah, we look at corporate governance, don't worry. How do you look at it? How integrated is it? You know, what examples can you give of the outcome of that investment decision? And at the same time, the FCA's own remit was revised to incorporate climate considerations. So not only are they policing it, but they, within their own strategy, have to enact it. So what does all that mean for the advisor community? Well, to the casual observer, it seems like you're slap in the middle of a tug of war between this increasing regulatory focus and an incredible commercial opportunity, but mixed in with some confusion and quite possibly some cynicism as to how, as an industry and as a profession, we can meet that opportunity. A Lancat report last year found that 80% of advisors like yourselves thought that confusing terminology was hampering progress in terms of advising in this space. And an Invesco survey had around 40% of advisors saying that a lack of knowledge on ESG and a lack of the quality and availability of data were barriers to making a recommendation to invest in this way. And that's incredibly challenging and potentially a genuine risk to your business, given that Advisor Attitudes report from Aegon last year quoted 41% of advisors having seen an increase in inquiries about ESG investments over the past year. So clients are asking for it, the regulator is telling you you've got to do it, but you don't feel that you've got the tools available to you to actually deliver on that. So where's that demand coming from? The graphics on this screen now represent the results of a government survey in 2019, which found that 2/3 of people would like their investments to have a positive impact, and more than half of them said that this would motivate them to invest more. Clearly quite attractive for us in the business that we have to motivate clients to invest more. When you disaggregate this data, what you see is that there's a trend for millennials to have an average, a higher level of impact. But it's clear from the wider responses, it's not only millennials that are interested in sustainable investing, but it is a significant proportion of it. Now, this is quite an interesting point because I'd like to bust the myth that millennials and the next generation, Gen Z, is it, are sort of, demanding this ESG investment. And once they become wealthy of their own right, they probably will lose interest because it's a bit of a fad and all that sort of thing. This isn't something that's going to be grown out of or is going to go out of fashion, because there's enough of the sort of cross section of society that are interested in this beyond just the millennials. Yes, it trends higher for millennials, but it's not all coming from millennials. The other reason I think it's really interesting is when you factor that in the context of multiple generations, because 5.5 trillion pounds worth of assets are set to change hands in the UK between now and 2055, peaking in 2035. So it's been dubbed the Great Wealth Transfer. I'm sure you've heard of it. Now, if you think about the fact that there's a base level of interest in sustainable investing that is higher for the next generation, suddenly sustainable investment is actually a really useful discussion point for you as an advisor to protect your book through that intergenerational transfer, because something like 65% of beneficiaries, when they inherit, will switch advisor because they don't have a relationship with their parents' advisor. They see them as dad's advisor, mum's advisor, not for me. So if you're already trusted and you're already having that dialogue around sustainable investing and how you can reflect their values in the inheritable assets before they become the inherited assets, you might be able to buck that trend and retain that sort of 65% figure. And that's particularly interesting when you see that for those respondents with higher than average investable assets, just checking my screen, there we go. When you see those the prospects with higher investable assets than average, they actually trended higher still, higher even than the millennial group. So wealthier people as a result of this survey are showing us more interested in sustainable investing even than the average person. So wealthy people, younger people, definitely a target market in terms of future-proofing your business. But I would be remiss of me not to admit that these figures only show half of the story. Because the same survey found that fewer than 15% of people are actually invested in this way. 30% for those with higher investable assets. So, the wealthier people possibly having more advice have actually, engaged with that sustainable investment opportunity already. And over half of respondents, which I think is even, possibly even more shocking, over half of respondents hadn't actually ever heard of responsible investing. So how do we reconcile that relatively low take-up with the demand figures that I mentioned earlier and that Paul alluded to at the outset? The reality is it's actually quite nuanced. Around 30% of people who currently hold investment place impact on people and planet among their top 5 most important factors when making an investment decision. 30%, quite a decent chunk. But a much larger 65% of people prioritize risk. 71% focused on return. 46% said cost was key. Now, I'm not suggesting that you can't have a cost-effective, good returning, sustainable investment proposition. But if people are presenting those kind of more traditional issues as their driving force for investment, they're not necessarily presenting to you as an ESG client, right? They're not presenting as an ethical client. Now, I do want to just pause, because Paul said at the beginning about myth busting, and I want to just pick up on that piece around risk, return, and cost, because like I said at the very beginning, ESG is no longer niche. And as a result, it is no longer really possible to charge a premium to offer an ESG offering. Because, supply and demand, if the market's being flooded by these ESG qualifying investments or ESG marketed investments, everyone's doing it, you can no longer say that you're a specialist because everybody has got an ESG offering. So you can't get away with charging more. And in fact, Morningstar studied it in 2020 and found the average fee for an ESG fund was about 0.57 versus 0.71 for a non-ESG fund. So I don't believe that investors have to pay more. So let's just park that one. With regards to risk and return, yes, if you filter out 90% of the universe, you're going to end up with less diversification, obviously, and also higher concentration, because what you're left with, you're going to be holding more of because it's all you've got to hold. But the reality is that modern ESG investments or sustainable investments, whatever buzzword you want to use, they don't work like that. They're actually looking to specifically mitigate risks associated to ESG issues. Thinking about that 15% sell-off in the DWS share price that I mentioned earlier, we're looking to mitigate the risk of a meaningful share price drop because of something related to an ESG scandal or controversy or policy shift that disadvantages those sorts of companies that are not moving with the times. We're looking for leaders on issues. Fidelity found last year that stocks with higher ESG ratings outperformed those with weaker ESG ratings during the COVID-related volatility we saw in 2020. Not least because the oil price was off a cliff at that point also. So sustainable investors, clearly not exposed to the oil price, were beneficiaries of 2020. About this year, that same lack of exposure has been painful for sustainable investors. I'm not going to pretend it hasn't. But if you think about and you can already see we're talking about very short-term snapshots of market conditions, and they're not necessarily locked in over the long term. So yes, if you look over a shorter time period where something that you're underexposed to or overexposed to is outperforming or underperforming, a sustainable versus conventional portfolio will perform differently. Let's not pretend that it won't perform differently, but differently doesn't necessarily mean worse. And even if there is a period of worse performance, it doesn't necessarily mean that it's locked in over the long term. In fact, in our own portfolios, with the exception of this year, which has been very challenging, we've seen the opposite. We've seen outperformance from our sustainable portfolios. Irrespective of that, like I said, if clients come to you stating cost, risk, return, they aren't coming up to you as an ESG client. But let's be honest, if I were to ask you, how many of you define the majority of your existing clients as ESG or sustainable investors, probably very few of you are going to say, yeah, my entire book is ethically focused. But if I ask you, how many of you define the majority of your existing investors and your existing clients as quite nice people, I'd like to think you're probably thinking, yeah, all of my clients are quite nice people. There's always one that's on the phone too much, I know that, but most of them quite nice people. In which case, when we talk about initiating a sustainable investment conversation with clients, instead of serving up alphabet soup and terminology, let's just start with them being quite nice people. Let's strip back the investment side for a moment and just focus on the wider behavioural shifts we've seen in recent years, prompted by devastating images of extreme weather, by documentary exposés into the effects of our industrial and agricultural practices, and the sort of unimaginable statistics like there's going to be more plastic than fish in our oceans by 2050. Mind-blowing kind of concepts, really. As you can see from the statistics on the screen, UK consumers now take far more collective accountability for the human impact on the world around us. We generally make more conscientious choices about where our food and household products come from and how it's packaged. We recycle more, we waste less, we monitor our energy use, especially this winter, and we consider the environmental cost, not just the financial one, of our travel arrangements. The people in these figures are your clients and they are your prospects. Now, I don't doubt that some of this behavioural shift comes from external pressure and circumstances and may almost be passive in nature. I'm not going to sit here and say every single person is banging the drum to be an absolute climate activist. I'm not. In fact, if I use myself as an example, much as I care about the environment and as aware as I am about my impact on the environment, if I look back maybe 10 years, if I'm completely honest, it wasn't a conscious decision in relation to plastic bags and plastic in the oceans that prompted me to bring reusable carrier bags when I buy my groceries. It was the fact that I'm a bit stingy and I didn't want to pay for one in store if I'd forgotten my own. If I think about recycling, it wasn't a personal, profound horror at landfill that made me recycle religiously. It was the fact that my main bin was only going every fortnight, but my recycling box was going every week, and I didn't want rubbish piling up outside my house. I wasn't motivated, purely altruistically in these behavioral shifts that I have seen in myself. It was encouraged, it was made convenient for me. What we're talking about really is nudge theory, but in being convenient, in being nudged, my behavior has changed. And I do now notice which companies aren't using recyclable packaging, and it bothers me and it impacts my purchasing decisions. So I've been educated as part of this process. And to an extent, I think where I'm going with this is that's the role that we have now in the financial profession, in terms of going back to that statistic about the lack of awareness. Less than half know that this is a way of investing. If we bring this topic to our clients and explain what it means and ask how it fits with their values, suddenly your non-ethical investors, your just standard investors asking about risk and return may well have an interest, but just didn't have an awareness. Now, based on my confessions there about recycling and plastic bags, you might be thinking I'm a horrible hypocrite, and that's fine. But actually, I'm very candid with clients that climate action hasn't always been a primary driver for me. And that's actually okay. And for you as advisors, I think it's really important to recognize and understand, because the UN Sustainable Development Goals aren't all climate centric, and neither will your clients be. I'll be honest, the majority of clients that I talk to about sustainability are motivated by the E in ESG, environmental, but many of them increasingly are asking about the S. They're asking about representation on boards of women and people of color. They're asking about the protection of indigenous populations through supply chains. These are the sorts of conversations we're having now. It's not all environmentally centric. And there is an SDG, Sustainable Development Goal, for everyone, quite possibly more than one. In the survey that I referred to earlier, respondents were asked which ones were the most important 5 goals to invest in. And these ones were the ones that they prioritized overall, with these ones ranked the most important among those with investable assets. So quite a wide variety: education, innovation, clean energy, absolutely up there, responsible consumption, those are sort of environmental ones, but plenty that are more to do with societal issues and equality issues. For me, the ones that resonate the most are number 4, 5, and 10. And I'd just like you to take a moment and look at them on screen and see which of those goals you care about or think are important. Maybe you already know which ones resonate with you the most, but just have a moment and see which ones resonate with you. And then honestly, with that in mind, tell me if you would choose not to allocate your personal investments to making a difference to that particular issue, if you knew that you could achieve it without it costing you more, without having to take on more risk, and without experiencing lower returns over the long term. Realistically, I don't think any of us would withhold our assets from doing that, given the caveats I've just said. So immediately, just by asking about what you care about from a very broad menu, not specific issues that you want to invest or divest from, just really big picture, what's going on in the world, what would make a difference, we've gone from a room full of nice people to a room full of sustainable investors. And I didn't give you any terminology definitions, and you didn't come to me with a list of predetermined exclusions. I just asked you what you care about. And I'm working on the assumption that once I know what you care about, we'll be able to build that in as part of the broader requirements of a long-term financial plan. And you'll notice I said part of. Really important. Sustainability is not a trump card criteria. It's simply an additional way to provide insight into your clients' needs, including their non-financial ones. But as advisors, you already know your clients' needs. You already know your clients' values. So maybe it's not about understanding and extracting that from your clients that's the concern. It's the idea that once you know what they care about, it can genuinely be incorporated as part of their plan. Now, the UN Sustainable Development Goals are the foundation of our own, the UN Sustainable Development Goals are the foundation of our own sustainable proposition. So we've got 4 pillars that incorporate these SDGs: healthcare and societal well-being, financial inclusion and education, circular economy and resources, and climate and environmental action. So we can cover 11 of those 17 goals. And we actually align our investments to those pillars and regularly map our portfolios against them, giving you as an advisor a clear output that effectively demonstrates the ongoing suitability of a recommendation against the corresponding values of your client, because it's linked to those same SDGs. We can support you with case studies against each of the SDGs, and we have white papers explaining those pillars and the investment themes they cover. In that way, we can explicitly show that the investments within our sustainable portfolios relate to the values that your clients have expressed. So we can give you that confidence that you might otherwise be lacking. But I want to revisit that point I made, that we haven't talked about whether this is an exclusionary approach or an engagement piece or an impact or whatever other buzzword you want to throw at me. And I'm going to be really maverick here and say you don't need to do that as an opening gambit in your conversation with clients about sustainability. When we talk to clients about risk, we don't ask them to provide us with acceptable volatility boundaries. That would be absurd. We go through an RPQ with them, and realistically, sometimes we have to have a conversation around it if their risk appetite is incongruous with their desired returns because they want to take no risk and shoot the lights out. Or conversely, if they're feeling quite risky, but they can't actually afford to take that level of risk given their financial objectives. We have that dialogue. When we talk to a client about their income requirements, we help them focus on what they need versus what they want by separating out their fixed and their discretionary spending, helping them to understand from that what a viable long-term withdrawal rate would be. We don't just say, how much do you want a month? We look at what's viable. We look at what's achievable. They give us their views and their feelings. And as an advisor, that is assimilated into a recommendation as a strategy. We don't ask them to dictate the strategy themselves. That's the value of what we do, right? That's what we're offering. That's our service. So why is it that with ESG, we would expect the client to dictate the strategy, i.e. exclude this, include that, be impact, be this, be the other? Why would we expect them to do that in what we've already seen could be their first ever formal conversation about responsible investing? They might not even have known it existed before. It's when you break it down and you think about it in terms of a comparison with other areas that we give advice on, it seems really weird that we'd be expecting that of our clients, right? If you stick with a discursive approach focused on what they care about in the first instance, then you can talk about the ways that those issues can be reflected through different sustainable investment approaches. And in doing so, for you, in terms of keeping your sanity, ESG doesn't become a filter that narrows your options in terms of where you can put their assets. And it doesn't become a box that necessitates a complete bespoke exclusionary approach on a client by client basis in order to be ticked. It simply enhances your wider KYC profile, and it kind of enables you to work out where the compromise is between risk, between return, between cost, and between values. In the same way that medium risk means something different to one client than another, and we try and quantify that as part of our process, sustainable investing will mean different things to different people. If you talk about the spectrum of possible approaches and how strategies can use positive engagement or can use exclusion and still have exposure, the clients that passionately want to exclude a specific industry will let you know, because the ones that really, really care are going to vocalize that once you started the conversation. But if you start it from that agenda, you're going to alienate the clients that are a little bit interested but not overly interested, or you're going to miss an opportunity to actually better facilitate your clients' values because you haven't captured it, because they've just gone, well, I don't want to exclude that will be too risky, or whatever else it might be. And I think the other important point around that kind of question of what to include or exclude is to be really honest and say very few companies are all good or all bad. And I'm going to use Unilever as an example. I'm sure you're all familiar with Unilever, massive consumer goods company, lots of everyday recognizable brands. As a house, we like it from a financial perspective. It's a long-term compounder of returns, a lot of brand awareness, a lot of sort of sticky consumer money there. But it doesn't seem very sustainable on the face of it, does it? If you were to start a conversation with your clients about things they don't want to invest in, I imagine that one of the things on the screen there would get a mention. Plastic packaging, not good. Palm oil, deforestation, not good. Testing on animals, quite a hot topic. However, many sustainable funds do use Unilever, and here's why. Although they're the third largest consumer of palm oil in the world, 99.6% of the palm oil they use is sustainably sourced, and they proactively committed to a deforestation-free supply chain by 2023, by next year. In fact, 67% of their total raw agricultural materials is sourced sustainably, and that's up 14% from 2010. So they're meaningfully moving in the right direction. We can see that. They've also been recognised by PETA for their ongoing contribution to regulatory change globally around animal testing. And I would describe PETA as quite militant in their their approach to objecting to unnecessary animal testing. They're quite strict on it. So they're not going to put their name to just anyone. And that's because Unilever are proponents of non-animal safety science, and they support a worldwide ban on testing for cosmetics by 2023. Currently, though, because of legislation in places like China, in some circumstances, their products will be subject to requirements for animal testing. Although it's worth noting that China actually ended mandatory animal testing requirements just last year for some imported cosmetics. So already that's kind of reducing. And there's some targets there on screen as well for reducing the virgin plastic within their packaging and to make sure that their packaging is reusable, recyclable, or compostable. So significant commitments. I could actually go on for a long time on this, but hopefully you can see that the sustainable investment case is not a binary one of include or exclude. And as such, why I caution against making that conversation with clients into a binary one. Unilever, as a large conglomerate, has power and reach to play a significant role in driving global change if they want to. As shareholders in Unilever, investors have the power of their own to influence the course of that change and to hold them accountable to the commitments like the ones on screen that they have made. So if you start the conversation around ESG from an exclusionary standpoint, what you could end up doing is giving up the power to influence for your clients who actually care significantly about an issue. You could give up exposure to a company that is pioneering a huge amount of positive action because they've got a large turning circle from perhaps where they were historically. That's not to say I don't think that screening out elements of your investment proposition is not a good approach at all. And clearly there are some sectors where all the good intentions of the world will never offset the damage inherent in them. Thermal coal for us as a business is a red line for that very reason. We exclude it across all of our mandates. Similarly, controversial weapons, another one that we will not touch for any clients, even if they particularly wanted us to. It's just something, it's a hard line for us. And some of the issues that are on screen about Unilever, or some of the issues that I've sort of mentioned in passing during the presentation, may well be red lines for your clients as well, in which case absolutely an exclusionary approach is right for them. My point is rather to reiterate that if you have the conversation around what matters to them, how that is enacted within that portfolio, it can be a broader discussion and can incorporate a range of ESG investment strategies. And that's worth noting as well, because by virtue of looking for good outcomes and good conduct and good business models, huge amounts of sectors end up screened out effectively anyway, without a negative screen on them, but just because they aren't scoring highly enough to be included. But if you've asked for a specific exclusion, you're going to have to need to demonstrate that that exclusion exists and is being upheld in order to demonstrate suitability. So by saying we're not going to have these exclusions, you're not saying we're just going to hold anything and call it ESG. We're not saying we're greenwashing. We're just saying, look, let's work on the basis that we want to include anything that's doing good, except for these bits that you really care strongly about. And, and we can do reporting and monitoring to assess that that still fits the client's needs without having this list of things to exclude. Another reason that I sort of talk about leaning away from exclusions and leaning into values is I had a client recently that came to me that had been managed to an exclusionary mandate, primarily climate action type investments, didn't want fossil fuels, didn't want, banks that were financing, didn't want fossil fuel exposure, and didn't want sort of big corporates and pharmaceuticals and that kind of thing. And I looked at his portfolio, and his portfolio that he was currently invested in absolutely upheld all of the exclusions, but it also held major banks like Wells Fargo and JP Morgan that actually, although they are not fossil fuel companies themselves, are financing huge amounts of fossil fuel exploration through their loan book. So for a sustainable client, I would never buy Wells Fargo or JP Morgan. It just wouldn't be something that I would do for them, bearing in mind that their values are anti-fossil fuels and these banks are not mitigating the fossil fuel risk. They also had Zalando in their portfolio. Now, Zalando is not a fossil fuel company. It actually has got a number of sustainable brands on it, but it's basically fast fashion. And no matter how how good you are in the context of fast fashion. Fast fashion still is a very environmentally damaging sector, because you've got the fibers, the petrochemical fibers that are used in the clothes. You've got the carbon footprint of the production of the clothes, possibly human rights issues in the production of the clothes as well. You've got the carbon footprint of those clothes, deliveries and returns, and the continual sort of transport issues there. And then you've got the kind of societal question of these payday, not payday loans, but the buy now pay later model, which, as we go into a recessionary environment, I think there's a societal question around that, and whether that's an appropriate way of positioning payment. Ethically, are you encouraging people to basically get into short-term debt in order to look good? That does sit very well with me. So Zalando, again, is not what I would consider a sustainable company that I would put in a sustainable investor's portfolio who has already said they're concerned about climate change and societal issues. But that portfolio was deemed suitable for him because it was upholding the exclusions. I think this is what, this is the binary, non-binary thing. It's if you're thinking about exclusions only, your eyes are going to be closed to something that actually your client feels really strongly against. And if they suddenly see that pop up in a portfolio, they could well question, like, why are we holding this when I care about the environment? And that's because it's an exclusions based, and that doesn't flag as exclusion. So there's a future proofing element there in terms of focusing on values and thinking outside the box on, well, actually, they haven't said they don't want this, but it doesn't resonate as something that would be a good fit for them. So again, I think there's a bigger picture piece. And then just lastly, to sort of wrap up on, in terms of the authenticity, I talked at the beginning about how clients are holding companies accountable if they're not authentic in the space. I think when you're talking to clients that are really passionate about sustainability, using a DFM firm that themselves are putting their money where their mouth is, that are practicing what they preach, walking the walk, whatever terrible analogy you want to use. I just threw out 3 there for quick succession for no reason at all. Looking at what these companies themselves are doing in order to further the cause of better outcomes for people and planet is really important. So it would be remiss of me not to point out that we have been net zero since 2010, carbon neutral since 2010. We've committed to net zero by 2030 across both our operations and our investments. We've got huge commitments around reduction of paper and energy, and 10% of our group profit annually goes towards charitable objectives as well. So what we can't achieve within our normal business operations, we're also trying to advance through philanthropic donations as well. So those sorts of stories, those sorts of anecdotes about who will be running their money, not just what the money will be invested in, I think also builds trust with your clients when you're talking about ESG. And with that, I will go to questions.
Thank you very much for that, Abika. A very informative session. We do have a couple of questions actually that have come in advance, so I've actually got these prepared for you. Actually, this was an interesting one, talking about acronyms, saying that 15 years ago, BRIC was all the rage. Now we have ESG. Will we be looking back in 15 years' time and just looking at ESG as another fad or trendy investment that came and went?
I think if you think about the BRICS back then, what they were as an acronym was an opportunity, right? It was like, this is an area of growth. And I think ESG certainly at the moment offers an exciting space for growth. If you think about governmental shifts, think about COP26 last year, there is this huge about getting greener. So to be exposed to that returns in terms of where the future revenue comes from. So why wouldn't you buy in now and get that opportunity? Have I frozen up or am I back? I'm good. So I think in terms of when we look back in 15 years and think ESG was just an opportunity and it's no longer on the table, I think the impetus might have faded then. If we suddenly in a green world and we fix climate change, the impetus to invest in this way as a growth opportunity taken over by something else that we probably can't even imagine yet. We'll probably be flying by then, I don't know. But if you think about ESG as a risk mitigator, I talked earlier about trying to avoid those pitfalls by seeing what companies are exposed to. If you think about ESG as a lens, a risk lens through investment, I don't think that's going anywhere. I think that we are all more accountable in our processes and the way that we assess companies on a multifaceted scale now, rather than just risk return, box tick, done. I think it will always be ESG in that scenario. And I think that what we currently call ESG investing may well become mainstream, but I think we'll always have a cohort of investors who have a higher bar and expect us to deliver investments that are held to that higher bar. So want us to be more impact centric, want us to be, more activist in the term, in terms of how we engage with the fund managers and so on and so forth. So kind of a yes and no. I think that there's a shift that is happening that will not be reversed, but there's definitely an immediate opportunity that is why it's such a hot topic at the moment.
Great stuff. And another one is, as well as seeing increasing awareness of ESG, stewardship in terms of investments is also increasing in conversations. How do you see the overlap there between the two?
I think, so earlier I talked about you don't have to just exclude things. You can also reflect your clients' values by having some exposure and holding them accountable. That only works if your DFM is actively engaging, and that can be through. So if you've got direct equity exposure, you would expect your investment managers to be voting on those issues, and not just voting in terms of, or on sustainable issues, I should say. And then the active engagement piece, I think is really important in terms of, holding companies to account, but also encouraging companies to do more. And we expect that from ourselves when we've got direct investments. I think that one of my colleagues, Siobhan, is going to be contributing a written piece as part of this sort of theme around stewardship, because it's something that we increasingly take quite seriously, and it's a huge amount of work to do that authentically. And again, that's another key differentiator when you're selecting a DFM space, to see what are you guys actually doing to where you are holding companies, to make sure that they are aligned with your clients' values.
Great stuff. I don't think there's any more questions being posed by the attendees today. So thanks for your time, Abika. The signals start to come and go a little bit, so it might be time to wrap things up. So once again, thanks for your contribution for us today. And obviously, the LGT Wealth Management range of assets are available for our advisors to select from our DFM panel going forwards. As always, we will get a recording of today's session out to anyone who registered for today's event. That'll be with you in the next 48 hours or so. We will have our next event scheduled towards late October, so keep an eye out in your inbox for the invite to drop in the coming weeks. So with that, I'll wrap up for today. Thank you for attending, and obviously if there's any further questions from today's session, fire them to your usual sales manager contact, and we'll make sure that we get a response to you. So thanks for your attendance today. Goodbye.